One wrong move when placing a trade can cost you big. We'll walk through each order type, market, limit, volume weighted average price, and more. At the end, you'll know how to avoid the biggest mistakes traders make.
We're going to move to thing number 5. Maybe we'll put that on the back burner for a follow-up edition of the 5 things. This is the tariff issue. We're going to get into our educational topic. Gary, today we're going to talk about the different types of stock orders. So that's thing number 5. Gary, let's start, and then I'm going to ask you on specific type of orders. But let's start. Why is this important to understand? Why do we need to be aware of the different types of stock orders that exist and their use cases?
So, big picture, Rob, is it has to do with control, right? People have this idea that, oh, well, you just go buy stock. And they don't really know what they're doing. And, one of the things, for better or worse, that the app Robinhood did was they made it really easy for people to trade. But the downside is people don't always know what they do and don't have control over. And so there are certain kinds of orders that will allow you to control time, others that will allow you to control stock prices, others that are contingent on other things. And so you use these different kinds of orders to control risk and prevent a really bad outcome. Because listen, if you're trying to buy $1,000 of stock and it's, something that trades, huge amounts like Apple or Nvidia, well, then it doesn't much matter what you do. You'll just get filled. But if you're a larger account, if you have a larger account and you might be trying to buy something that's maybe less liquid, or a lot of people, I don't recommend this, but a lot of people are trading options. Those are less liquid. And so having more control over your order and understanding the kinds of risks that you're taking with each different kind of order, I think is something that matters.
Yeah, no doubt. Gary, we're going to get into each of the different types of orders. So, Gary, let's start with limit order. What is it? How does it work?
All right. So a limit order is an order that would be executed at a price that you specify or better. So imagine, you want to buy a stock, XYZ, and, the stock is trading at, $99.50. And, you don't want to pay more than $100. And so you could put in an order that says, I'll buy this stock, but not if the price goes up too much. Alternatively, maybe that XYZ stock, is coming down and you're looking at it and saying, well, I would buy this if it gets to 95. I'm just making up numbers here, right? And in that situation, you could put in a limit order that would instruct your trading software to only buy the stock if you can get it at 95 or below, right? And so I use that a lot. Like earlier today, I saw a stock that I really like. It was trading down and I put in an order way below the market. I'm like, listen, if this thing crashes in the illiquid pre-market, I'm going to pick up stock, because I knew once the market opened, it would recover once there was volume. And that is what happened. But here's the quick and easy way to think about it. With a limit order, you have control over cost, but not your execution timing, right? Your order controls your cost, but when it comes to the timing will be whenever the stock trades at the level that you want, right? And so limit order, you control cost, but not the timing.
Gary, real quick, how long can you keep a limit order open generally?
So now this answer will depend on your trading system. This is not a general answer. This is not trading advice, really important. Generally, in most systems, if you put a limit order in and it is not filled by the 4 p.m. close, then the order will expire. You can put in a good indefinitely. There is a place where you can check something that says, leave this order open indefinitely and, just have it filled. Now, I never do that. You could, but I don't do it for 2 reasons. One, there is always the slight possibility that you might forget, right? You got an order in, but you forget and you use capital for something else, and maybe that order gets executed and now you have a margin call, right? You're using too much capital, or your exposures are not what you wanted them to be. It's possible to forget. More than that, and this is the key thing. Let's say you put in an order saying, well, I would buy XYZ if the stock gets to 95. And that's based on the conditions that exist that day. But what have we seen, Rob, over the last 3 trading days? We've seen some
Right.
stocks get hammered 20, 30, 40% in 3 days on news. Now, I don't think the tariff stuff is nearly as horrible as many people are making it out to be, but it doesn't matter, right? The point is, there could be things that happen that would change your idea. And, if you were to put in, like, again, the hypothetical $95 limit order on, XYZ stock, um, you know, if there's news on it 3 weeks down the road and you get filled, you could get filled at 95 when it's on its way down to 75 or
Right.
65.
Yep.
Right. So these things can happen. So you can leave a limit order outstanding for as long as you want, but I would be very cautious before doing that. And it's not something, let's just say it's not something I've ever done before.
Great. Gary, moving forward, we'll go some rapid fire. Tell us about market order. What is it? How does that work?
All right. So a market order is basically the opposite of a limit order. You're going to have control over the timing, but not the price. What happens with a market order is you just send an order to the market that says, I want to buy, 100 shares of NVIDIA now. Just go buy it, whatever the price is. And most of the time, if you have a liquid stock and you're not trying to buy too much of it, a market order is fine. The reason I don't use market orders that much is because there are really rare situations where liquidity has just disappeared instantly. And people have put in market orders thinking that they were going to be filled at a reasonable price. Liquidity disappeared and they ended up getting filled at insane prices, like double the price that they expected. Or if they're selling, half the price they expected. It's not something that happens often. But in my opinion, unless you're trying to trade huge amounts of stock, there's just no reason to take that risk. And in my situation, I prefer to set a price that makes sense to me rather than just let it go. The situations where you would use a market order are ones where it's a really liquid security and you want it done immediately. Sometimes, like, it maybe I'm making this up. Maybe it's like 359 on a Friday. You really want to own this thing over the weekend. You think there's news coming. That's a situation where you just click market order and you get it done instantly rather than, waiting and being stuck, not being able to buy it until Monday.
Got it. Gary, market on close order. MOC.
So that is an order that gets executed as a market order at the end of the trading day. And the idea is that the price will be at or very close to the closing price. The reason you would do that is because when people mark their books, they mark at the closing price. So let me give you an example, right? Rob, imagine a situation. So we're using this hypothetical stock XYZ, right? And let's say that 1 million shares trade during the day, and that stock is right around $100. And so $1 million trades between 99 and a half and 101. And so all of that trading takes place there. And then at the end of the day, the last trade takes place at $90, right? What that means is that even though the stock was trading at or around or above 100 all day, when it gets marked to market, it will be marked at the price at 4 p.m. And so, people often will want to have a price that reflects the closing price. That's when you would use something like that.
Makes sense. Gary, moving forward, we've got an all or nothing, also known as fill or kill. What type of order there, Gary?
Yeah, all or nothing, AON, fill or kill, FOK. Rob, how would you pronounce that? Never mind.
Fuck.
That's an order that would be executed
I guess
only
it
if the
depends in which context, right?
exactly. Is it a buy order or a sell order?
Yeah. How am I feeling about it?
Yeah, that's FOK. You know what? If you know how to pronounce that, put that in the comments, please. Just let me
Yes.
know. We're curious. We're
Yes.
not really
Yes.
sure.
Exactly.
That's an FOK order, fill or
That's
kill.
right. That's right.
Anyway, That order only gets executed if the entire order can be filled immediately. So you would use that typically if you're bidding on multiple exchanges or trying to set up a pair trade. So in the example that we just gave, say you want to buy 100 shares of our, XYZ at, 99 and a half. That order will only be executed if you can buy 100 shares right away at that price. If it's only going to be a partial fill, it won't buy anything for you.
Got it. Okay. Thank you for breaking that down, Gary. We got a couple more here. Bear with us. Volume weighted average price, Gary. What type of order is that? Tell us more.
Yeah, volume weighted average price, otherwise known as the VWAP. That actually is how it's pronounced. Uh, yeah.
Yeah. Are you sure?
No. Anyway, that's an order that it tries to match the average volume weighted price during the trading day, right? So the way you'd calculate that is if you take the total dollar value of the stock in that particular security that's traded that day, divided by the total number of shares traded, you'd end up with the volume weighted average price. And it's a way to match the average market price for a whole day. The reason you would do this is, let's say the stock is really volatile. You're not sure. Should I buy it now? Should I buy it, closer to the close? Should I buy it in the first 15 minutes of trading? I don't know. Is it going to go up or down? Like sometimes stocks are really volatile and people don't want to have to pick, a moment. And by the way, one of the stocks that I look at today traded in a range of 450 to 650. That is a more than 40% range between the low and the high trade of the day. So if you're dealing with a security like that, you might just say, you know what? I don't want to deal with the trading and figure out, like, am I buying at 450? Am I buying at 6? Am I buying at 625? Am I buying at 5? Like, who knows? And so what people will do in that situation is just say, you know what? Just give me the volume weighted average price. And you enter that order and then you just let it run all day. And, fingers crossed, the algorithms tend to be pretty good. Obviously, there's no guarantee, but they tend to get you pretty close to the target.
Gary, and finally, the pairs trade, our last order.
Yeah, that's a conditional order. And what it does is you can think about a pairs trade one of two ways. One is you would execute two separate orders at the same time. You would do that, like, for instance, useful for risk arbitrage, something I used to do. Where investors will be buying one security and selling another at the same time, hoping to profit when the spread between them collapses. So what you do is you would say, okay, buy me however many shares of XYZ, and at the same time, sell me, this many shares of ABC. And they get executed together. And that way you maintain that relationship, right? Between the number of shares of one that you want to own and the number of shares of the other that you want to be short. So it's a merger arbitrage strategy. The other thing you can do with a conditional trade is you can set conditions in one security to cause a trade in another. So like the example that I used in the written version of the 5 things, I put up a trading box showing what an order entry looks like. So you could say, if Nvidia trades at more than a certain price, sell my Microsoft position, right? And so somebody might say, well, wait, why would you want to do that? And the answer might be because you might want to only have a certain amount of exposure to the mega cap tech stocks. So, if you have a big position in Nvidia and it goes from, a certain percent to another, it's grown, you might say, well, I want to reduce my exposure. I don't want to own, this much exposure. And so, well, I don't necessarily want to sell Nvidia. What would I do? I'd want to sell Microsoft or Apple or, one of these other, or Amazon. So you can set up a conditional order where a change in the price of one security causes a trade in a different security. So these aren't the only kinds of orders that can be entered, but it's a pretty good description of the ones that you, as basically, if you don't know about these are the ones you need. If you do know about them, then you have your own trading system and you didn't need to watch the segment. But thanks for being here for us. We appreciate it.
Yeah, no doubt, no doubt. Gary, any final kind of takeaways for you, from you, excuse me, to listeners? What would be kind of that one key takeaway just about order types from you?
Yeah. So look, you have your choices. And the thing that I tried to do in our description is to give you a sense of the benefits and risks of every one of these kinds of trades. What I would suggest for most of you, unless you're dealing with really unusual circumstances, most of the time I use limit orders. And the reason I do that is just to prevent the, 1 in a million possibility that the stock price could move a lot while the order is being executed. Now, somebody might say, well, wait a minute, but if I do that, I may not get filled. The stock is moving. How do I do that? And the way that you can use a combination limit and market order to ensure that you get executed, but not at an idiotic price, is what you can do is you can use a limit order. Let's say you're buying, but you can set the price that you're willing to pay above the offered price. Right. And so, like, in the example we're using, if XYZ is trading at 99.5, you might say, I'm willing to pay up to $101. And you'll probably get executed before the stock moves that much. But it's a way of ensuring that you get executed or filled immediately without running the risk that you end up, paying a $200 or $300 price. Again, that doesn't happen often, but you don't want it to happen to you.
Yeah, no doubt. Great stuff there, Gary. Thanks for breaking all of that down. Please, by all means, head to deepknowledgeinvesting.com. Use the Ask Gary feature. If you have any questions about investing, just really anything that comes to mind, might even make it on an episode of the five things. So be sure to head to deepknowledgeinvesting.com and use that Ask Gary feature. That concludes this week's version of the five things. No, we ran a little bit long this week, but great conversation, lots going on. I think it was definitely due. This was the tariff issue. Please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. We'd love if you'd consider a premium subscription at $100 per month, access to the entire portfolio, no gated content, the whole 9 yards there. Special attention from Gary. We'll even throw that into the mix as well. But more than anything, thank you for watching here. Please like, comment, subscribe. Tell us how bad we are. We'd love to hear that too. That's always the most fun.